Picture the statement for a year the market went nowhere. 12 months of headlines, 12 months of drama, and the index finishes exactly where it started, flat. Now look at a fund from that same year. It promised 3 times the market's daily move, and it delivered that promise perfectly. It did not end flat. It lost 20%. Nothing broke. Nobody mismanaged anything. The fund did exactly what its prospectus said it would do every single day. This is the strange math of leveraged funds, and it is built into the product on purpose. A leveraged ETF is a fund built to deliver a multiple of an index's return. 2 times, 3 times. Some run inverse, designed to rise when the index falls. The key word sits in the first sentence of every prospectus, and it is the word most holders never register. Daily. The fund promises 3 times the index's return today. It promises nothing at all about a week, a month, or a year. Who builds these, and why? Issuers earn management fees near 1%, several times what plain index funds charge, and traders pay it willingly for one-day precision. The product exists because short-term traders want exact daily leverage without a margin account. To deliver the multiple, the fund holds derivatives, mostly total return swaps with large banks that pay $3 of index exposure for every $1 invested. And here is the mechanical heart of the product. Near every close, the fund rebalances. After an up day, it must add exposure. After a down day, it must cut exposure. It has no choice and no opinion. The 3-to-1 promise resets every single night, and that reset is where everything that follows comes from. Now the math, with real numbers. Put $1,000 in the index and $1,000 in a 3x fund tracking it. Day 1, the index rises 10% to $1,100. The fund rises 30% to $1,300. So far, exactly as advertised. Day 2, the index gives it all back, falling 9.1%, precisely enough to land on $1,000 again. A perfect round trip. The fund falls 3 times that, 27.3%, and $1,300 minus 27.3% is $945. The index went nowhere, and the leveraged fund lost $55. Run the identical round trip again, and it holds $894. Again, $845. A 4th time, $799. 4 flat round trips. The index is unchanged, and the fund is down 20%. That is the chart from the top of this episode, and now the machine behind it is visible. Notice what did not cause this. Not fees, not tracking error. The fund hit its 3x target perfectly on all 8 days. The loss is manufactured by compounding, a multiplied daily return chained through a bumpy path. Mathematicians call it volatility drag. So the paradox from the top resolves mechanically. The fund never promised 3 times the year. It promised 3 times each day, and a chain of daily multiples compounds into something nobody promised at all. And the honest version cuts both ways. In a smooth, one-directional trend, the compounding works in the holder's favor. 10 quiet up days of 2% turn a 3x fund into considerably more than 3 times the index's gain. The same product and the same arithmetic, opposite outcomes. The only difference between those 2 charts is the path. Trends compound kindly, chop grinds. That is why 2 investors can hold the identical fund across the identical year and tell opposite stories. Neither was cheated, they rode different paths. And the flatter and choppier the index, the faster the grind. Markets spend far more of their time chopping than trending, which is why holding periods measured in months treat these funds so poorly. Now the part that stops this from being an abstract exercise. February 5, 2018. An exchange-traded note called XIV, engineered to deliver the daily inverse of a volatility index, had spent 5 calm years compounding beautifully. Nearly $2 billion wrote it. That afternoon, the volatility index more than doubled in a single session, its largest one-day percentage spike on record at the time. The daily reset worked precisely as documented, and the note lost more than 90% of its value into the next morning. Its issuer, Credit Suisse, announced the note's termination within days, and holders were paid out near the lows. The losses were not a malfunction and not a fraud. They were the product's own documented math, arriving all at once on people who had treated a daily instrument as a 5-year holding. Regulators had described this exact failure years earlier. A joint SEC and FINRA alert back in 2009 warned that holding leveraged products longer than a day can produce results that differ dramatically from the stated objective. The warning was not fine print. It was the whole mechanism, stated plainly 9 years in advance. So, the one-line version. Leveraged ETFs are daily instruments, and the same arithmetic that flatters them in a trend quietly bills them in chop. This has been how it actually works, from Finance in Review. Educational content only, never investment advice.